Welcome to the Probability Brief, the signal check on the world's most telling prediction markets. The Probability Brief's objective is to deliver clear, data-driven intelligence on how major events are being priced in real time. Each episode examines fast-moving prediction markets, high-impact whale trades, regulatory momentum, and shifts in crowd psychology. The show explains what moved, why it changed, and what the probabilities reveal about the path ahead. Making complex market signals accessible, actionable, and easy for listeners to follow. Today is Wednesday, February 25, 2026, and our theme is the hydrogen hedge and the 4 a.m. liquidity pivot. We are looking at a Wednesday where the global energy probability ecosystems are in a state of high-velocity recalibration. While mainstream financial news is dissecting the latest earnings from the traditional oil and gas sector, the real action is happening in the decentralized markets for green hydrogen infrastructure. We are witnessing a structural shift where the crowd is moving away from speculative innovation hype and toward a more sober assessment of regulatory deliverability. This shift is creating a massive information asymmetry between institutional hedgers and retail traders, particularly regarding the newly proposed transatlantic hydrogen pipeline accord. In our recurring segment, Signal Mechanics, we explore how a signal propagates through the market. Today, we are looking at why a single, seemingly obscure regulatory leak shifted the probability of the accord's passage by 15% in mere minutes. At roughly 4 p.m. yesterday, an unverified internal memo from the European Energy Commission began circulating on private Discord servers. In a vacuum, a rumor might cause a temporary spike, but here, the rumor acted as a narrative bridge for existing whale trades. When the whales saw the leak, they didn't just buy the yes side, they used the liquidity to flush out the no holders, creating a cascade of forced liquidations. This teaches us that a signal is only as powerful as the market microstructure it enters. If the order book is thin, even a whisper can feel like a shout. Turning to market microstories, we zoom in on a small but meaningful movement, a sudden 3% reversal in the niche market for Port of Rotterdam ammonia storage permits. This happened at 4 a.m. Universal Time Coordinated, a time usually characterized by low volume and high volatility. The move was triggered by a quiet update to a municipal environmental filing that had been overlooked by algorithmic scanners. This microstory is a teachable moment about incentive design. The traders who moved the market at 4 a.m. weren't guessing. They were incentivized to monitor the most granular level of bureaucracy to find mispriced opportunities. They recognized that the permit's approval was a prerequisite for the broader hydrogen accord, creating a lead-lag effect that the broader market has yet to fully price in. For our structural context, we address how markets price tech adoption curves in the face of geopolitical tension. As tensions rise in traditional fuel corridors, the probability of fast-track green tech adoption has hit a new high of 42%. However, markets aren't just pricing the breakthrough itself. They are pricing the regulatory friction associated with it. We are seeing a divergence where the probability of the technology working is nearly 90%, but the probability of it being deployed at scale within 3 years is only 20%. This implementation gap is where the most sophisticated traders are currently living, hedging against the optimism of the adoption curve with the reality of geopolitical gridlock. In today's crowd psychology deep dive, we find a classic case of narrative anchoring. Despite the clear signals of regulatory delays, a significant portion of the retail crowd remains anchored to a spring launch narrative for the new hydrogen grid. This has led to a confirmation cascade, where any minor positive update is amplified, while major negative signals, like the 4 a.m. liquidity shift, are dismissed as market noise. This creates a high risk of a panic dip if the official announcement on Friday confirms the delay. The attention scarcity of the general public means they only see the loudest headlines, while the quiet, structural decay of the original narrative goes unnoticed until it's too late. Our regulatory trajectory analysis focuses on the committee dynamics within the Senate Energy and Natural Resources Committee. By interpreting agency signals from recent closed-door testimonies, we can see a shift in stakeholder incentives. Traditionally, heavy industry was the primary opponent of the hydrogen accord, but our analysis of recent lobbying filings suggests they are now co-opting the narrative to secure subsidies. This is a historical analog to the 2005 Energy Policy Act, where initial opposition was a feint to maximize leverage in the final legislative process. Understanding this shift changes the probability of passage from a low-conviction guess to a data-driven expectation based on incentive alignment. In the market memory segment, we look back at how prediction markets mispriced the 2023 fusion energy breakthrough. At that time, markets reacted with an overconfidence cycle that lasted for 6 months before correcting sharply when the commercialization reality set in. Today, the market has a scar tissue memory of that event, which is why we see such high volatility clusters around any hydrogen-related tech news. The market is correcting much faster this time, showing that the narrative persistence of pure hype is shrinking in favor of structural data. For our cross-market correlation segment, we are tracking a fascinating link between the rare earth mineral futures and the green hydrogen odds. When the liquidity in rare earths dries up due to export restrictions, the no side of the hydrogen accord market immediately sees a spike in volume. This is because you cannot build the electrolyzers required for the accord without those minerals. Sentiment in the clean energy domain is no longer independent, it is functionally tethered to the mining and logistics domain, creating a renewable signal that sophisticated traders use to front-run broader market moves. Finally, in what traders missed this week, we highlight a quiet regulatory filing regarding subsea cable indemnification. While the crowd was focused on the pipeline's path, this filing suggests a major shift in who carries the liability for infrastructure failure. This is an early sign of narrative decay for the companies that were expected to profit from risk-free construction. It is an undervalued signal that the real alpha for the coming quarter lies in the insurance and maintenance markets, not the construction firms. To synthesize this, let's look at the incentive map. Who benefits from the current volatility? High-frequency arbitrageurs who thrive on the 4 a.m. spikes. Who loses? Retail traders who are anchored to the spring launch narrative. Who is signaling? The municipal permit offices whose filings are the first domino in the regulatory chain. Who is silent? The major sovereign wealth funds, which suggests they are still accumulating positions before the official announcement moves the price for good. This incentive map reveals that while the public debate is about green energy, the market movement is about regulatory capture and liquidity depth. Episode summary and closing. Today we analyzed the signal mechanics of the hydrogen accord leak, decoded the 4 a.m. liquidity pivot in the ammonia markets, and explored how narrative anchoring is creating a confirmation cascade in the retail sector. We looked at the historical analogs of energy legislation and identified the cross-market correlation between minerals and hydrogen. Most importantly, we mapped the incentives that show the silent players are the ones truly moving the needle. Thank you for listening to the Probability Brief. If you found this valuable, please like, subscribe, follow, and share with someone who watches the odds like you do. The sources for today's episode are Polymarket, Bureau of Labor Statistics, Twitter Trends, Senate hearing transcripts, European Energy Commission internal advisories, Municipal environmental filings, Piraeus and Rotterdam. This podcast is for informational purposes only and does not constitute financial, investment, or betting advice. All market probabilities are subject to change. Episodes may be generated using fully original, fictional but realistic market movements. Some scenarios, market movements, or examples discussed in this episode may be illustrative or simulated for explanatory purposes.